What's going on, traders? Welcome back to Explain the Charts. Today, November 7th, 2025, we're diving deep into Meta Platforms, ticker Meta, which has been on an absolute roller coaster. As you can see on this daily chart, the stock has experienced a dramatic fall from its recent highs, and the big question is whether this is a dip to buy or a warning sign of more pain to come. The news cycle has been buzzing, primarily around their Q3 earnings report from late October, and we're going to break down what it all means for the stock price. First, let's talk about the headlines that triggered this chaos. The big story was the Q3 earnings report released around October 29th and 30th. While revenue growth was actually impressive, up 26% year-over-year to over $51 billion, investors were completely spooked by a massive one-time tax charge of nearly $16 billion. This absolutely crushed their earnings per share, which came in at just $1.05 versus an expected $6.70. But the real fear factor, and what's causing this prolonged downward pressure, is management's aggressive spending forecast for 2026. CEO Mark Zuckerberg is doubling down on AI, projecting capital expenditures to be notably larger in 2026 than the already increased $70 to $72 billion forecast for 2025. This has brought back what some analysts are calling memories of the metaverse days, where massive spending led to uncertain returns, severely pressuring margins. Investors are clearly worried that history is repeating itself, punishing the stock despite strong performance in the core advertising business. Now let's correlate this news with the price action. Focusing on the daily chart from late October, we can pinpoint the exact moment the market panicked. Meta was trading comfortably above $750 just before the report on October 29th, showing strength and stability. Then, on October 30th, we see this catastrophic gap down on enormous volume. The price opened around $669 and closed even lower at $666, a staggering drop. This single-day event wiped out nearly $200 billion in market value, marking Meta's worst trading day in years. The selling pressure continued relentlessly in the following days, showing that this wasn't just a one-day panic, but a significant shift in investor sentiment. Let's zoom back out to the full daily chart to understand the larger technical picture. Prior to this earnings disaster, Meta was in a very strong and clear uptrend for most of the year, even reaching an all-time high of $796.25 back in mid-August. After that peak, the stock entered a corrective phase, forming a lower high around $780 in September before consolidating. The post-earnings drop completely shattered this market structure, confirming a major trend reversal from bullish to bearish. The price sliced through what should have been major support levels around $700 and even $650 as if they weren't there. Our new, formidable resistance level is now the bottom of that gap, right around the $650 to $667 area. Any attempt by the bulls to rally will likely face a wall of selling pressure in that zone. On the downside, the market is desperately searching for a new support level to form. The price action from yesterday, November 6th, shows some tentative buying interest around the $618 to $620 area, which is the current low we must watch. Let's switch to the 1-hour chart to get a closer look at the very recent price action. Here we can see the intense selling volume that came in yesterday, pushing the price down from a session high of $636 to that critical low of $618. The price has been attempting a minor bounce today, but notice the volume is relatively weak compared to the sell-off. This pattern can sometimes be interpreted as a classic bear flag, a temporary pause which could suggest another leg down is possible. For intraday traders, the key resistance to watch on this time frame is yesterday's high around $636. A decisive break above that level could trigger a short-term squeeze, potentially pushing the price up towards the $645 to $650 zone. However, failure to break above it keeps the immediate pressure firmly on the downside. Drilling down even further to the 15-minute chart, we can see the minute-by-minute battle. The price is coiling in a tight range, consolidating after yesterday's sharp move down. This type of consolidation often precedes the next significant move as bulls and bears filled their positions. A break below the $618 low would be a very bearish signal in the immediate short term, opening the door for a test of the major psychological level at $600. Conversely, if buyers can push for a sustained move above the local resistance around $628 and then $636, it could give bulls some temporary hope for a larger recovery. So, putting it all together, let's summarize the bull and bear cases. The bearish case is strong and clear right now. Fundamentally, the narrative is dominated by fear over massive AI spending, uncertain return on investment, and compressed future margins. Technically, the bullish trend is broken, key support levels are shattered, and the stock is in a clear downtrend. The path of least resistance appears to be downwards, with a potential target at the $600 psychological level. If that level breaks, we could even see a move towards the $580 to $585 area, which acted as a support zone back in late March and early April of this year. The bullish case is far more speculative at this point. It rests entirely on the idea that this massive sell-off is an overreaction by the market. Bulls would argue that Meta remains a cash flow machine and its aggressive AI spending will ultimately pay off, cementing its long-term market dominance. For a bullish thesis to gain any technical traction, we need to see the price reclaim the $650 level with conviction and high volume. A break and hold above the gap fill area near $667 would be a much stronger confirmation that a true bottom is in, but we are a long way from that now. Let's quickly recap the key levels to watch. Immediate resistance is at $636, followed by the major gap resistance zone from $650 to $667. Key support is at the recent low of $618. A break below that targets the major psychological level of $600, and then the $585 area. My unbiased take is that the bearish momentum is likely to continue in the short term. I would put a 70% probability on a test of the $600 level in the coming week or two. This likelihood increases if we see continued broad market weakness or more negative analyst commentary on tech spending. For any kind of meaningful reversal, bulls need to orchestrate a powerful move to reclaim that $650 resistance level on high volume. Keep a close eye on any further company guidance on capital expenditures and the overall sentiment in the tech sector, as that will be the primary driver. And now for our disclaimer. This video is for informational and educational purposes only and should not be considered financial advice. Trading stocks involves risk, and you should always conduct your own research and consult with a qualified financial professional before making any investment decisions. Thanks for watching Explain the Charts. Don't forget to like and subscribe, and we'll see you in the next one.